Hey everyone, I'm Dr. Woolworth, and today we're going to briefly talk about what costs get capitalized when a company purchases equipment, like maybe a new pizza oven or a van. So capitalizing means that when we purchase something that is used over a period of time, we can't deduct it usually all right away. The IRS wants us to, if we're going to use it, like that pizza oven for several years, we have to deduct the cost of that pizza oven over several years as well, often known as the useful life. So when we're having to capitalize and put it up on our balance sheet as an asset and then systematically expense it via depreciation via time, what kind of cost associated with something like a delivery vehicle or a pizza oven would go up onto that balance sheet? Is it just the initial invoice for purchasing it? What about the shipping for getting it here? Did you have to pay for somebody to install it? These are all great questions. So when we buy equipment, we're not just going to look at that sticker price, the amount that we paid, the invoice, the cost for the delivery van. We're going to need to include all the cost to get the asset ready for its intended use. So some examples of that would be the purchase price of equipment. Okay. Did you have any sales tax? That's going to be included as well. Did you have to pay to bring the equipment to your location? If you did, any shipping or freight in would need to be included. What about insurance? Maybe it was a really expensive and you were concerned that it might get lost. So you might pay for insurance while in transit. Now, something I want to point out here is this is only insurance while in transit. Insurance to just regular operating insurance after it's ready to go, that you would not capitalize. That would be an operating expense. What if you get it in and you have to install that pizza oven? Okay, or that big piece of equipment. Maybe you need to reinforce the concrete of the floor so it doesn't fall through to the floor below it or damage something. So any installation costs like setting up, assembling, mounting that equipment, and then once it's set, maybe we need to test it. Is it working properly? So testing our equipment would also end up being capitalized, not expensed, because again, it's all a part of getting that asset, that equipment, ready for its intended use. And one other thing is maybe either some special wiring, plumbing, or painting that we need, right? If it's just for that asset, okay, just to get it operational. If it's already operational, now we're doing this, that might be treated differently. But if we need it to get operational, then that would also be capitalized. Okay, so again, all of these here, we are capitalizing in order to get the asset ready for its intended use. But some costs should not be capitalized. Okay, some costs really are operating expenses and should be expensed when incurred. So things like normal repairs, maintenance, or training costs, those are going to be expensed. So if you have to train the employee on how to use this new equipment or machine, that's going to be an expense, typically not a part of the equipment cost. And then, so think about it this way. Capitalize anything to get the asset ready for its intended purpose. But once it's ready to be used, then pretty much everything else is going to go to expense. So let's take a really quick look here, going through an example. Here we have Jose purchased a delivery van for his business and through an online auction. The winning bid for the van was $34,250. And then in addition, he incurred some following expenses. So in order to get the van to him, he had to have it shipped. Then we had some painting. So you had to match the other fleet vehicles. So if his delivery vans were all sapphire blue and this would happen to be forest green, then we needed to paint it to sapphire blue. Right, so we have the painting to match our fleet vehicles. And then we also have registration costs. So let's think about registration costs. That's going and registering your vehicle with the DMV, and that's just so you can operate it, and you'll have this registration cost usually in some form every year. So that is not a part of getting it to ready for use. And then though you have your sales tax and annual registration, that is for purchasing your vehicle. So getting it ready for use, you needed to pay the sales tax. So that would also be capitalized. But what about your annual registration fee? That is an annual fee. You'll be paying that every year. We're not going to capitalize that. We're also, the wash and detailing, that's not necessary for it to operate. It could operate, as a dirty vehicle. And an engine tune-up for $305, that would be repairs and maintenance as well. So that would not be required to be capitalized. So if we added up our $34,250 plus our shipping cost of $1,290, and then the paint to match the other fleet vehicles of $1,690, and our $2,900 of sales tax, this would come up and be $40,130. And this is the amount that would be capitalized, which means it would be an asset that is recorded on your balance sheet, and then it will be deducted over its useful life. So if we thought this vehicle is going to last us 5 years, we will take the cost and deduct it over 5 years. Now there's special rules, Section 179, bonus depreciation, that could affect that, but we're just talking straight cost recovery right now. Okay, so, and we'll talk about all that depreciation in a future video.